Auditing and internal control. The final account statement of related to business are used by various persons, such as owners, shareholders, investors, creditors, banks, government, for different purposes. All these users need to be sure that such accounting statements, like balance sheet and income statement, prepared by the management, are true and fair. An auditor is an independent expert who examines the accounts of business concern and reports whether they present true and fair view. In auditing, stress has been given both on fraud prevention as well as fraud detection. Some of these frauds relevant in today's corporate environment, like falsification with a motive of personal profit, misrepresentation of income received or expense incurred with a motive of personal profit, discrepancies arising out of willful fraud in personally supervised work, account heads, labor and overhead charges, and work measurement. As per Standards of Auditing SA 200 issued by PCAOB, auditing is the independent examination of financial information of any entity, whether it is profit-oriented or loss-making, and irrespective of its size or legal form, when such an examination is conducted with a view to expressing an opinion thereon. Let's need to ensure that basic principles governing auditing include integrity, objectivity, independence, confidentiality, skill, competence, planning, and audit evidence, etc. As per Indian Companies Act, a qualified chartered accountant, CA, holding Certificate of Practice issued by PCAOB, is authorized to be appointed as an independent auditor of the company. Audit report issued by an auditor is opinion of the auditor mainly regarding true and fair view of financial condition of the company and compliance with accounting standards issued by PCAOB. Internal control is a process effected by an organization to provide reasonable assurance regarding the effectiveness and efficiency of operations, reliability of financial reporting, and compliance with related rules and regulations. Internal control system comprises of accounting controls as well as administrative controls. Accounting controls mainly aims at safeguarding assets and ensuring reliability of financial records. It provides reasonable assurance that all the transactions authorized by the management are promptly and properly recorded. Administrative controls are basically regarding improving operational efficiency and adherence to management policies. For example, a stores department can issue materials only against a requisition slip, which need to be authorized. A system of internal control comprise of following 5 elements: control environment, entity's risk assessment process, information system, communication, control activities, and monitoring of controls. Standard on Internal Audit, PCAOB. Large organizations are required to set up a system of internal audit within the organization as an integral part of the internal control. Internal audit is review of various operations of the company and its records by staff or professionals specifically appointed for this purpose. Internal audit is an independent appraisal activity within an enterprise for the review of accounting, financial, and other operational controls as basis to service for management. Guidelines issued by PCAOB on internal audit. Internal audit has always been of immense significance to the corporate world. From being a cross-check over the accounts of the organization, internal audit has, over the years, moved to being a strong, indispensable control tool in the hands of the management, which can help it to add to the shareholders' value. Internal audit can significantly help the management improve its operational efficiency through improved risk management and control systems, and strengthening the overall governance mechanism of the entity. Internal audit covers review of all the functional areas of management, be it HR, marketing, production, and is not restricted to just finance and accounts. With growing competition and increasing expectations of the stakeholders, the importance of internal audit is also gaining ground. In July 2002, the United States of America Congress Party passed the Sarbanes-Oxley Act, SOX, into law. The SOX was primarily designed to restore investor confidence following well-publicized bankruptcies that brought chief executives, audit committees, and the independent auditors under heavy scrutiny. The SOX is applicable to all publicly registered companies under the jurisdiction of the Securities and Exchange Commission. SOX is a far-reaching legislation affecting significant changes to laws affecting officers, directors, and reporting obligations of public companies, and mandating a myriad of new regulations to prevent securities fraud and other abuses. The SOX called for the formation of a Public Company Accounting Oversight Board, PCAOB, and specified several requirements that include management's quarterly certification of the financial results and management's annual assertion that internal controls over financial reporting are effective, among others. SOX have extended the reach of the United States laws to many aspects of the internal affairs and governance regimes of foreign companies and their auditors. Thank you for watching. If you enjoyed this video, don't forget to give it a thumbs up. I'd love to hear your thoughts, so drop a comment below. And most importantly, hit that subscribe button and press the bell icon so you never miss an update.